Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading.
So let me go back to my chart of the VIX. This time I'm going to scroll over here. Well, what's interesting is that on 9/29, which was actually the period that we were just looking at most recently for the most recent breakout or turnaround on the euro dollar, we get this big breakout to the top side where the VIX essentially broke way above even the extremes that it had been at over the last couple of years. So it had stopped at the same levels that it stopped in January and March of last year, but then gapped up above. We got this big rally. Well, what does that tell me? It tells me that investors are developing a healthy sense of fear and uncertainty. What are they going to do? And historically, what they've generally done is they start to shift their capital into higher risk assets, or into lower risk assets, quality assets, and that drives demand for the dollar, which are needed to be able to buy those T-notes and T-bills. Now, it's interesting because if you think back to what's going on today in the market, so the Treasury and the Fed are out there, they're trying to save everything. And one of the ways in which they've proposed to try to solve the problems in the capital markets is essentially to inject a bunch of capital into the banks and their primary dealer network, et cetera, to try to loosen up credit and keep rates as low as they are. Well, in order to do that, in order to put that money into the banks, they got to get it from somewhere, right? They can't just print it, wink, wink. They're going to have to get it from somewhere, and they're going to get it from a debt issue. Now, that's interesting because, you know, there currently is a debt market. There's a market for government debt. They issue debt all the time. So if they're going to have to increase the pace at which they issue debt, something interesting will happen. Because what happens when you increase supply of any particular thing out there in the market where demand is reasonably fixed? What will happen is your price drops. So they'll be selling bonds for a little bit cheaper, for a little bit of a discount. And what happens is, and what we're looking at right now, this is a chart of the 10-year yield. What that measures is it measures the yield amount on the 10-year T-note. So as it begins to rise, that means that those bond prices are coming down in value. The bond prices are actually falling, which is what we would expect to happen during a period where the Treasury is going to have to start issuing a lot more debt. They're going to have to issue it at competitive prices. That means that yields are going to grow. So if we back up here just a little bit, one of the things I'm looking at, and a direct answer to the question that I posed myself on, how long is the dollar likely to go? One of the things that we're looking for is we're looking for not only a collapse in volatility, not only are we looking for volatility to come back down, which is what we just looked at on the VIX, but we're also looking for stability in yields. We're looking for yields to start to slow. Well, I've drawn a couple of lines here, one along the bottom of this little double bottom, if you will, almost a quadruple bottom. We've been here in January, March, September, and then real close here in October. And we've got resistance up here around 4250 or so. If we were to turn around at this point or up around resistance and begin to drop again, I would start to expect more a disruption in the dollar trend, because if yields start to come down, what that means is there's just not as much demand, or one of the things that could mean is that there's not as much demand for treasuries, et cetera. And that in turn will indicate that there's not as much demand for the U.S. dollar. Conversely, if the market does in fact if the market for yields begins to break up above this level here, then we start looking at the trend to basically renew itself. We're looking for opportunity to the upside in yields. We're also looking for opportunity for upside on the dollar. So as a specific example, actually, one of the Forex markets that's very sensitive to yields is the dollar franc. The dollar Swiss franc is very sensitive to yield changes in the U.S. So as we start to break up above, or if we do start to break up above the 4250, there's a couple of ways that we could take advantage of that same information. And notice how close we are right now. This could happen in the next week or two or so. So as far as developing a forecast plan and then executing on that plan, we start to establish benchmarks. We start to look for or consciously evaluate where are we, and is it significant that we've broken up above 4.25% on the 10-year note? let me switch gears here. So I mentioned that one of the markets that's very sensitive to that is the dollar franc. So for those of you out there who are technicians or like me are kind of a blend between technicals and fundamentals, you'll notice something very key is kind of shaping up here on the dollar franc. We've got this little consolidation pattern, which one way or the other, the market does not typically stay within a tightening range for very long and is likely to break out. If yields were to break out to the upside, indicating a demand for the dollar and kind of feeds back into itself and continues to generate demand for itself, what we would expect is for there to be an opportunity to go long the dollar franc. Now, one of the convenient ways we can do that is by buying a call, for example, on the dollar franc. Now, I say that with one caveat because as most option traders, I'm sure I'm not alone. And every time we're evaluating a trading opportunity, we have kind of an interest of just a generic trade. We just want to get in and speculate on market movement. We have kind of a choice to make. We can either buy or go long an option or short it. Now, what we'll see lots of times is traders are inclined to short a market or to short the options when premiums are really inflated, which because volatility is so high, that's one of the things we're seeing is higher premiums. That means that the seller, someone shorting those options, is going to get paid more. The only caveat to that is that, of course, they're high for a reason. So if volatility continues like it did, you can see this candle pattern here where the market moved a few hundred pips, which is a lot in the dollar franc. So if we get one of these again, we could find ourselves on the losing position if it were to the downside, for example, when we were selling puts. However, it is one of those things we look at, and I find that when the market is really volatile like this, and we're pretty convinced that in the intermediate term the dollar is probably going to continue to either be stronger or stabilize, then selling a put down below support may not be such a bad idea. So just one of the ways in which we take advantage of that. Now, so imagine that we're in this trade, we're short a put, we're expecting the market to go up, and it continues to channel in this fairly tight range. It's not really going anywhere. One of the things we can look at for a benchmark to say, well, when is enough enough, particularly if we're in a losing position, is to keep our eyes on yields. This is one of the tools that I use to try to determine is my long position on the dollar franc in danger? Do I need to take some action here? So this little example that I was showing you here on between bond yields versus the dollar franc I was talking to my second point about forecasting dollar strength. So we talked about uncertainty on the VIX, but I also talked about using capital flows, and this is specifically the way in which I would do that is by looking at yields on bonds to see what's going on and am I getting any warning signs. It's not uncommon for these two markets to lag each other a little bit, so it's quite normal to get a little bit of advance warning on the TNX before anything has happened on the dollar franc. Now, one of the things that, and by the way, to go back and kind of wrap up the discussion about the VIX, I wanted to make sure that I had done it some credit in recognizing where are we right now. We're at all-time records here on the VIX. I mean, or at least for some time today we were. And despite the fact that the market closed up by about 400 points, we really didn't see a big decline in investor sentiment. So the market's up by 400 points, and yet we barely began to eat into the big day that we had yesterday. So this is telling me that volatility and therefore fear is actually quite high. Again, one of the warnings I'm looking for to try to determine is the trend on the dollar done or not is what's going on here with the VIX. Is the VIX beginning to depreciate in real ways, or is it just merely reflecting the volatility in the market? So that's one of the things we're looking for is for the VIX to start coming back down into historical levels before we start getting too bearish on the dollar.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.